Welcome back, friends. Today we will discuss order types and trading. Most of us need to learn all the categories and order types to execute our trades. And as a beginner, when we try to search for this knowledge, we get this in bits and pieces and don't find a single place to refer our doubts. So let's find out here. A market order is a buy or sell order to be executed immediately at current market prices. Market orders are therefore used when certainty of execution is a priority over price of execution. A market order is the simplest of the order types. Limit orders allow you to set a price at which you want to buy or sell a stock. In limit orders, your purchase or sale will go through only when the price reaches the level that you specify. Now let's talk about stop-loss orders. When you have a position in the market, you fear the losses that can happen when the price starts moving against you. If you place an order to limit such a loss, it is called as a stop-loss order. So for example, if you have bought a stock at Rs 100 and you want to limit the loss at 95, you can place an order in the system to sell the stock as soon as the stock comes to 95. Such an order is called as a stop-loss, as you are placing it to stop a loss which could be more than what you are ready to risk. Stop-loss versus stop-loss market orders. The difference between a stop-loss, SL, and a normal order is the trigger price. In a normal order, you get to choose either limit order or market orders. In a stop-loss order you choose limit or market, but with a trigger price. What a trigger price does is that it activates your order which otherwise is inactive. So sometimes stop-loss order, which is by default a stop-loss limited order, becomes risky because there is a possibility that trigger price is not reached and directly price jumps to a worse price. That is why it is recommended to put stop-loss market order where orders gets activated whenever price is on or lower or higher of your trigger price. In this scenario you may get some slippage, but there is always guarantee of execution. Let's try to understand with one example here. Suppose you took long position, means you bought a stock at 100 price and you don't want your loss more than 20, you will need to place a stop-loss order of 80, right? Let's suppose you put simple stop-loss order, we can say it as stop-loss limited order also, as 80. Then in this case suppose market becomes very volatile and trade price shifted directly from 100 to 79, means no trade happened at price 80. In this scenario your stop-loss order will not get executed and you may have to bear losses more than expectations. To avoid this in a volatile market, better to put stop-loss market order at 80 where your order will become active whenever price become equal or lower than 80, and it always give guarantee of execution and limit your losses. Only drawback of SLM orders is that you may get some slippage. Let's talk about slippage. Slippage is nothing but the extra points you lose against your bet for any market order. Suppose current market price of a stock is 100 and you put a buy market order, in those milliseconds gap market may reach to 102 or 99 or anything near to the price you are betting. It also depends on current market volatility. So possibility is that your order may get executed on or better or worse price. So the difference of your bet and execution price is called slippage. Mostly slippage goes against the trader. It can even though be favorable in rare cases. Now we have clear understanding of all orders, market, limit, stop-loss market orders. There are few order types available which may be combination of any of these four, so let's find out what are those. Bracket orders. Bracket orders are basically orders where you can define your entry, stop-loss and even target in a single order. After you place bracket order you can even get to sleep because it is a complete order where you get automation of executions. Once you place a bracket order it creates a position plus two pending orders. One pending order is for your target and another is for your stop-loss. Whenever any condition gets fulfilled, all other orders will be cancelled and no manual intervention required. Bracket orders clearly define your risk in the market. That's why you get more leverage of your capital money, means less margin required. Bracket orders are always day trading orders. One more important thing which I did not discuss above since I didn't want you to get confused is about trailing stop loss. In a bracketed order you can define a trailing stop loss. Now what is trailing stop loss? In a trailing stop loss your stop loss order becomes dynamic and move towards your positional side whenever condition met. This is hard to understand from here, so let's take one example. Suppose you enter at 100 with long position and your stop loss is 20 points, means on 80. Now you define a trailing stop loss as 20. What does it mean? It means that if market moves in your favor and reach to 120, 20 points above your entry point, your stop loss will also move 20. Means in this case new SL will be 80 plus 20 equals 100. Cover orders. Cover orders are also combination of your entry order and only stop loss order. In cover order you cannot place a target, so you need to exit manually. If you don't do so it will be exited on your stop loss if reached or will be executed at day end, since this is also AMIS, intraday, orders. AMO orders. AMO orders are aftermarket orders. You can place AMO orders and it will go in queue. These will only execute when actual trading hours begins but on priority since placed earlier. Only advantage of AMO order is that you made your decision on entering or exiting a particular trade and you expecting a sudden increase in volatility after market opens, but still it is very subjective and no price guarantee in AMO orders. Quick bites are: 1. Day trading orders are also called as MIS orders, and if you enter with MIS order it will throw you out of the market before day end at market price in case you don't execute anything manual. 2. Normal orders are normal, and if you enter in a position with normal order, it will be active till that particular contract expires. So this is useful for swing or positional traders who wants to keep their positions overnight. 3. Basic order types are market orders, limit orders, stop loss limit orders, stop loss market orders. All these orders are available for both MIS and normal cases. 4. Few subcategories are made to give advantage of executions on top of these basic order types, like cover orders and bracket orders. Now we should have a fair idea of most of the order types available for trading. Still, if you have a doubt, don't hesitate to drop email to the email I mentioned below. Thanks for watching my video. Also drop me suggestions for any improvements. Subscribe this channel to get notified with more videos. Thanks again and bye bye for now.